Hello, everyone. Welcome back to the channel. This is Matt with Green Bar Trading, and we have another weekly watch list video for you here. In this video, I am going to try to explain what the Fed means to the overall stock market and the overall economy. Because there's one thing we're going to watch this week. It's going to be the FOMC. On Wednesday is when they're going to release their policy decisions, okay? This is something everyone in the world is going to be watching. So there's one thing that's going to be on my mind this week, and that's the Fed. I don't care about earnings. I don't care about the war in Ukraine. There's that simple FOMC meeting that I think we should all be focused on. The Fed created this inflation problem, okay? For those that don't know, in 2020 and 2021, because we do have some, new traders here that got in 2021, unfortunately, and saw a majority of the stocks that they bought go straight down. And in 2020, 2021, the Fed made monetary policy so easy because they were afraid that the coronavirus was going to destroy the economy. So they created this demand from consumers by giving them so much money in the way of stimulus checks. A lot of that money ended up in Wall Street. So you saw in 2020 and 2021, the stock market went straight up. Profits for companies went straight up because all that stimulus and all the money that the Fed printed went into consumers' pockets and then went right out of consumers' pockets and into all those big companies by buying so much products. And in turn, that created a supply chain issue. So when you have so much demand and so much buying, all the products that the consumers want, all of a sudden the supply goes down. And, with labor also that pulled back, obviously, because of the coronavirus, it created these huge supply chain issues, which created massive inflation. Now, we can debate for, a long time whether they were way too aggressive by giving way too many checks out. And, in my opinion, that is 1,000% what caused inflation to be so bad. Even before the war in Ukraine, you saw inflation numbers that you haven't seen in many, many decades, okay? So it was already bad. And then you had the war in Ukraine make it even worse. So now the Fed is playing catch up. So this is going to be pretty wild. The main goal of the Fed when they're wanting to raise rates is to slow a hot economy, okay? The only thing is the war in Ukraine and with inflation so high and gas prices so high, it already slowed the economy. So now you have the Fed, which is also going to be slowing the economy by raising rates. So when they raise rates, that means, car loans will be more, mortgage rates will be higher. And they try to make it unattractive to be buying things. So that creates demand to come down. The only issue is that's already starting to happen. People can't afford all these extra costs every single month. I mean, from your food bills to your gas prices, to heat your home if you have oil, energy, anything, your electricity bills, health insurance, life insurance, every single thing has gone up a crazy amount. So that all comes out of consumers' pockets, that extra money they have. to spend and buy goods, well, that is also going to be pulling back demand. So now, you have a major issue ahead with the potential for stagflation. And what stagflation is basically when inflation continues to run up, but you have demand now pulling back and the GDP pulling back as well, which is not good and then can lead to recession. So the Fed created this mess and now they're going to try to get out of it. Their balance sheet is so high. You name it, we have these issues. And that's why you're seeing the stock market trying to find out where it should be trading, where these companies' valuations should be. And it's very choppy trading. It's been very choppy in 2022, all because of inflation. The war, yes, added to it, but we were already pulling back to correction territory before Russia ever invaded. So, with the sanctions and everything, that is definitely going to, continue to make inflation a lot worse. So that was, me trying to explain the best I can at 7 o'clock in the morning on a Saturday about what the Fed did, what they're doing, and what we should be watching for. Wednesday, March 16th, okay, at 2 o'clock, right here, FOMC announcement on the Fed funds rate. They're supposed to raise 0.25%. They were originally going to do possibly a 0.5% raise. But with the war, they're going to really need to do this very strategically and carefully. You're going to hear that word a lot when Powell talks here at 2:30. You're going to hear that word carefully a lot because of the uncertainty in that geopolitical arena. The market hates uncertainty. So they're going to be very careful about what they're going to do and what they're going to say. So Wednesday is a huge day. Tuesday, you have the producer price index. That's another inflation gauge. So last week we had the CPI, which was 7.9%. It was the highest in like 40 years, whatever it was, but it was expected at 7.9%. The only thing is, at that point, that was before the war. These are a month behind. That CPI print was for the previous month. So what happens here in March that will be reported in April, that is going to take into account the high gas prices, the war in Ukraine, what it has done for inflation. So we're going to have a lot of things coming up here. And, this is one thing that we look at. So this is our compass, where we came from, where it looks like we might be headed. I always start looking at the overall market. Every morning I do this. Every day I look at this, the SPY and the Qs. I also look at some of the futures, the NASDAQ, the ES, the Russell 2K. But this is what I'm really, really interested in, the S&P 500. This is your 500 biggest, best companies. So this is going to give you the best gauge on what the overall market, technically speaking, looks like it wants to do. I'm going to explain some of these lines here and the stuff that I have circled, this trend line, and then the 20 EMA, and then, of course, this red box, okay? So if you are new, I'm going to explain what I am looking at here and how in last week's video, this was called right here. This was called. And I'm going to start right here. So take a look at this past week's trading. This bar here, this bar here, this bounce here, and then closing down right there at about 420. Okay, so if you look at this area and then you look at this area here, very similar. You have a big drop. Okay, so these two bars here, you have these two bars here. And then you have the bounce back. 2 days here, you have the bounce back, the 2 days here, and then you have another candle here closing just about at the low of the day. Same pattern here. What this has led to was breaking down further to new lows the following week. So, just going by this pattern of lower highs, lower lows, lower highs, lower lows, the potential here to revisit this 15% correction area, well, it's looking pretty much like that can happen. So, just going by previous levels, this is the way the market works. You have it come down, bounces up, comes back down, makes a lower low, comes up, makes a lower high, and then comes back down and makes a lower low. The market never will just go straight down. So you'll see these bounces. And when it bounces and the market is up, 700 points, you get excited. You think, okay, this is it. These are called dead cat bounces in such a bearish market. Okay, they get people to sucker in and go long only to get slammed right back down. So this is a time to be careful. Now, this red box here, very clear level of support here, and then support here. And now that we broke under it and closed under it, it is now acting as resistance. So until, and you can see the 20 EMA here, the 20 EMA has really held up as a clear level, clear indicator, of where we're going to see that possible resistance. And the way it's coming in here with this trend line, this is going to be a spot that we're going to want to see eventually break. If we're ever going to change this trend. So this trend is obviously, going down, and the thought of making lower lows at this point, technically looking at the daily chart, well, that's what it looks like we want to do here. You have the 50 moving average about to cross under the 200 moving average. That is extremely bearish. Extremely bearish. And that is going to happen this coming week. You're going to see this cross over, and that's called the death cross. So, like we said in the last video, we're running into a huge amount of resistance here. Massive resistance. So that's a technical look at the overall market. And now if we look at the Qs, which is the tech market, you had the cross here. So the 50 went under the 200. This is the death cross. This is what I'm talking about. You also have the 20 EMA, which I love this indicator on the daily chart. This is going to be possible resistance. But you can see this red box right here. Why do I have it here? Support, support, broke under it, bounced right back over its support, and now this is acting as resistance. That's the way these things work. So the chart to me does not look great. If we break under this 318 here, this level, this is about 20% down on the Qs, you're going into bear market territory. And you have the Fed this week. So I think, you know, looking at the overall market like this, knowing what to look for as far as what the Fed is going to be showing on Wednesday, if you're trading, just be very careful. Manage your risk, preserve your capital. Please, just, you know, take less share size if you have to. Don't watch the markets all day. The way that I'm day trading is getting in and out, a couple of trades, and that's it. And then I'm shutting it down for the day. It's just very, very choppy. And when you do see those big green days, you know, everything looks great. And then the next day, it all falls apart. So, you know, this is some things I hope maybe taught you guys something as far as the Fed goes. If it did, hit the thumbs up for the video. If you have any questions at all, leave them down in the comments section. I answer every single question. Also, if you want to join our Discord community, you're more than welcome. The description, the link is in the description for you guys. So that's it. I will see you back on the next one. Take care.